The Fed is slowly but surely revealing its tapering plans. Will tapering drive rates higher? Hi, I'm Jim Griffin of Derivative Logic, here to get you straight to smart. In the meeting minutes from the Fed's July meeting released last Wednesday, most Fed officials agreed they could start reducing, aka tapering, the pace of their bond buying purchases this year because they had hit their inflation goal and were closer to reaching their standard for progress on reducing unemployment. While the minutes confirmed that the Fed sees the current bout of inflation as transitory and therefore holds little influence on its decision on the timing and scope of a taper, they also confirmed that the Fed feels there's still more work to do on its other, more important mandate, creating jobs. While job gains have been strong, averaging about 600,000 new jobs a month through July this year, broader measures still show slack in the jobs market. As such, we suspect the Fed will signal an impending taper at its September 22nd policy meeting and make a formal announcement at its November meeting. The fly in the rosé, a derailing of job growth in the meantime stemming from the Delta variant. If current consensus economic forecasts are realized and the Fed begins to reduce its asset purchases later this year, easing off the stimulus throttle at an increasing pace, the 10-year Treasury yield should climb modestly to around 1.5% by year's end. The consensus view that America may have already passed peak economic growth for the year only strengthens this view. Should that come to pass, the yield curve would steepen as corporate credit growth, housing, and interest rate-sensitive sectors could absorb the Fed's dovish taper, in which the Fed commits to keep short-term interest rates ultra-low for longer than many in the markets expect, even as inflation remains relatively high. For the week ahead, it's all about the Fed's gathering in Jackson Hole, Wyoming. While the event is always closely watched by markets and heavily covered by the financial media, this year's gathering takes on special significance given the global economic turmoil triggered by the pandemic. Fed Chair Powell will be the most watched attendee, no doubt, as he's expected to continue to guide markets down the taper path during the gathering by dripping tidbits of commentary aimed at eliminating any communication missteps. From all of us at Derivative Logic, have a great week.